We're at a point of major economic transition right now. That's why it's so important for you to get set up in the right ways while avoiding all the risks that are out there. At the end of the video, I'll tell you what I think you should avoid, what you should gravitate towards based on the current economic environment. But first, we have to get a little bit heavier, a little bit darker. We've got to talk about the negative ramifications that are going to happen because of this economic transition. There will be increased suicide rates, there will be increased income insecurity, poverty, homelessness. And understand, none of this is to scare you or spook you. I'm just telling you verifiable facts that you know to be true. And we'll talk about that. I've been known to mix in a few of my own thoughts or opinions from time to time, but understand none of it is personalized trading advice for you. And we'll get to all of that as I talk to you about the Great American Debt Bomb, this unfair economic setup that we've all been put into. And the saddest part is that the majority of the pain that's going to come from this unfair economic setup, it is yet to be felt. And depending on your situation, it might be felt in your retirement savings, it might be felt in your pension, it might be felt when you lose your job, when you see civil unrest, or you see the overall quality of life declining. A lot of these things are going to happen, and I want to talk about them in this video so you know what to do about them. We've got rising delinquency rates, which I told you was on the way for quite some time now, and it's just getting started. We've got real estate starting to come down, and I've told you that was on the way for a while, and we're just starting to see the beginnings of that now. And this is all leading up to the worst thing of all is a central bank digital currency. And these are just some examples of what you're going to be dealing with from among many, many others. For many of you, this is your first time here. My name is Peter Leeds, and along with my entire team, we publish the world-famous Stock Pick newsletter. And we're well into our third decade of doing exactly this and only this. That should tell you everything you need to know about the quality of the content that we're putting out. In 1913, the Federal Reserve was created. Since then, consumer prices have gone up 24 times. And the original dollar from 1913, how much value of that is left, is approximately 4 cents. In other words, since the creation of the evil Federal Reserve, the dollar has lost 96% of its purchasing power. That's all so far. It'll keep going. It'll get worse. According to the Federal Reserve and the U.S. Department of the Treasury, foreign countries held a total of 7.2 trillion US dollars in US Treasury securities as of November 2022. So I ask you, what happens when the dollar backdraft begins in earnest? A lot of countries are reliant on the US dollar, and tides are shifting, things are changing. Mexico, for example, unpegged its currency from the US dollar. You've got Saudi Arabia selling oil in currencies other than the US dollar, which is adding tremendous uncertainty to the petrodollar that America has enjoyed for all of these years. All oil was bought and sold in US dollars. That's changing. The tides are shifting. Now you've got Iran, Russia, China coming up with a reserve currency, a gold-backed reserve currency. And if I've got to buy the US dollar or a gold-backed currency, the better value long-term is the gold-backed currency. And you know that debts are growing wildly, out of control, and they won't stop. So if there's a debt owed to someone, there's someone expecting that money. And the problem is, people talk about a debt jubilee where we just forgive all debts or eliminate all debts. Most of the debts are owed to American citizens. So we'd have to default on ourselves. There's no way out of this. All debts, all liabilities eventually have to be dealt with one way or another. Whether that's defaulting through inflation or just defaulting straight up. But however you look at it, what historically happens in almost every occasion is that the pain point or the financial failures get divided up into millions of slices and put on the shoulders of regular middle-class people. There will be consequences when we deal with the debts that we've racked up. And they put unfunded liabilities like Social Security and Medicare aside. They say, well, that's a different kind of debt. We can't pay it. We admit we cannot pay these unfunded liabilities. But we'll just put it over here and treat it differently for some reason. So when you hear the amount of American debt, that doesn't even count the unfunded liabilities because they swept those under the rug. And as this pension shortfall problem comes to light, it gets into the media for the first time. I don't know why it's taking so long. When that happens, the politicians will say, well, there's a problem, we're going to fix it, and they'll do things to try and fix it, and they'll do enough to make it look like they've addressed the problem to get reelected. But what it's going to involve, this is a 100% guarantee, is that you'll have greater contributions for lower payouts, and they'll give you less services. That's a guarantee. There'll be defaults, not just corporate defaults, but personal defaults as well. There will be home repossessions. People can't afford to pay their mortgage. I even know someone who recently lost their house. And what you might see is people just walking away from their homes. And with the interest rates increasing at the fastest rate in 41 years, we're seeing people who have a mortgage who owe more on the house than the house is worth. And that's why you're going to start seeing people walk away from their house. If you owe $500,000 on a house that's worth $250,000, the logical move is to walk away. And with the recent rise in delinquencies, that's coming in right on schedule, just like I told you, this is the beginning of it. It starts now. When you plant seeds in a garden, it's not overgrown on the first day, but it begins on the first day. That's where we are. Delinquencies will only increase from here. Consumer debt across all categories totaled $16.9 trillion, up about $1.3 trillion from a year ago as balances rose across all major categories. Mortgages, auto loans, and credit card delinquencies all increased, though to still low levels. That's what I'm talking about, still low levels. It's very low right now. Yes, it is. It's starting off at a low point, and it increases from here. You've got consumer debt at an all-time record high. It's never been higher. And at the same time, we've got interest rates that are at their highest level in over 40 years. How do you think this is going to play out? Household debt rises to $16.9 trillion. Credit cards passed pre-pandemic high. Total household debt rose by $394 billion, or 2.4%, to $16.9 trillion in the fourth quarter of 2022, according to the latest quarterly report on household debt and credit. Credit card balances increased by $61 billion to reach $986 billion, surpassing the pre-pandemic high. Mortgage balances rose $11.9 trillion, auto loan balances to $1.55 trillion, and student loan balances to $1.6 trillion. The share of current debt transitioning into delinquency has increased for nearly all types of ways that debt can be taken on. Mortgages, auto loans, credit cards, student loans, you name it. And I told you that the pain point is still ahead of us. Most of the pain from these increased interest rates is yet to be felt. But think about that. The pain will come from the increased interest rates, and the reason they increased interest rates was to bring down inflation, which they themselves caused in the first place. To sum up this economic clown show that we're all dealing with right now, I'm going to read you something that you've probably heard before. You probably know this one. She swallowed the bird to catch the spider that wriggled and jiggled and tickled inside her. She swallowed the spider to catch the fly. I don't know why she swallowed a fly. Perhaps she'll die. They make a mistake and they try to fix it with a worse mistake, and they try to fix it with a worse mistake. If you remember that child's story, she eventually swallowed a dog to get the cat, to get the mouse, yada yada. That story is just basically about what the Federal Reserve is doing. They keep making worse mistakes to make up for the earlier mistakes that weren't as bad, such as increasing interest rates to deal with inflation that they themselves caused in the first place when they swallowed that first fly. Inflation itself is at its highest level in more than 41 years. And last year, let me ask you this. How many times last year did the Federal Reserve raise interest rates? It was 7. Then they did another one in January. Last year, there were 4 consecutive interest rate increases of 3/4 of a percentage point, which boosts rates for multiple consumer debt instruments such as credit cards, mortgages, and auto loans. Student loan debt also increased for the month after staying flat during much of the pandemic amid government-backed amnesty for borrowers. The total balance hit $1.6 trillion in the fourth quarter. Auto loan debt edged higher to $1.55 trillion, while credit card balances rose to just shy of $1 trillion. Total U.S. government debt now stands at $31.5 trillion, not counting unfunded liabilities, because remember, that's under the carpet. But the scary part is that that's up from just 29.6 trillion at the end of 2022. So it's almost $2 trillion greater than at the end of the year already in a couple of months. That's about $1 trillion a month. That is not sustainable, and it's not fiscally sound at all. Now this is the one that I'm not understanding. I'll admit that. The delusion, I always talk about this curtain being pulled back, and it's partly pulled back now, but there's a lot more to go. And I've never understood how insane things got, how far out of control the delusion actually reached. When you're talking about buying real estate in the metaverse, when you're talking about non-fungible tokens that are traded for 6 figures, even things like real estate got delusional. When home price affordability is out of reach, it doesn't make sense that it's increasing so rapidly. All this inflation was put into stocks and real estate, and now it's starting to unwind. Even some widely followed stocks like Meta or Match.com or Tesla were all overvalued, and now they're starting to come back towards a more realistic valuation. But check out this perfect timing of this comment we got beneath one of our YouTube videos. We're in a complete clown world with gold selling under $2,000, while NFTs of digital ape drawings are going for $50,000 to $250,000. That's from BA117. You said it exactly. Thank you. Good timing for that comment. Brokerage Redfin shows that investor purchases of American homes fell a record 45.8% year over year last quarter, surpassing the decline seen in 2008 as the housing bubble was bursting. With housing affordability at a record low, home sales and prices have begun to retreat nationwide, especially in pandemic boomtowns like Austin, Texas, Phoenix, and Bozeman, Montana. Each of these places saw an influx of remote workers, robust population growth, and unprecedented home price appreciation during the pandemic. As the real estate market softens, strategists at Goldman Sachs projected various markets, including Austin and Phoenix, will likely see peak-to-trough home declines of more than 25%. I believe we're in for much more of a decline than 25%. And there's over 700,000 homes which have been bought by real estate investing companies and corporate landlords, such as Pretium and Invitation Homes, which is the largest amount ever amassed by U.S. real estate investors. They've bought a whole bunch of homes so that middle-class people can't afford them or get access to them, and then they rent them out. These companies, which are owning and holding up all of these homes, are going to be in a lot of trouble as these home prices start to decline. And if you didn't think that the odds were stacked against you enough, you're trying to buy a home, they're too expensive, they're out of your price range, and that was before interest rates started going higher. Now you've got these companies that are going on or approaching 1 million homes that they've purchased and are keeping off of the market. Release those back into the market, it'll solve all these problems for home price affordability. But don't worry, let them go through the pain point that's coming up, then they'll have to release a lot of these houses, especially if they wind up going out of business. That'll help prices come down, which they already will be coming down on their own anyways. Now we'll get to the bonus part where I'm going to tell you about what to do about some of this stuff. But I got to tell you that always keep in mind, there's always hope, and there's a lot of opportunity right now. There's way, way, way more risks than opportunities. So it's about mainly protecting yourself, keeping your head down. But there are a few moves you can make that'll help you deal with this. You're not powerless. You can land on your feet if you make the right choices now. So I've summed up sort of the situation we're in. We talked about the dollar death, this debt bomb, demographics which are much more slow moving, so they won't really have an impact before all this other stuff does, but still something you have to keep in mind. We've got the declining delusion, and as that approaches reality even more, that means prices will come down even more to realistic levels, actually beyond or lower than realistic levels before it starts to recover. And we've got a decline in real estate just starting now. That is the setup that you're in. And interest rates are at a 40-year high. Debts are at an all-time high. So what does that mean? It means that you should expect a big change in financial hardships. Civil unrest, retirement savings are going to be taking a hit. And in fact, they already have begun to take that hit. There's going to be more suicides, more homelessness. You can be homeless because the economy got pulled out from underneath your feet. We go into this recession, if it becomes even more than that, a depression maybe, you're going to find that there's a lot more people living in their van in the Walmart parking lot. However you look at it, it's going to be an overall decline in the quality of your life. And again, I'll say, I'm not trying to make you depressed or spook you or anything. This is what you're facing. Some people won't even be paying attention to any of this, but you are. So you're in a better place than a lot of them. You're going to have the time to make the moves you need to make, which I'll tell you about right now, to set yourself up so you land on your feet and do a lot better than you otherwise would have in a really bad situation. And all of this is going to lead up to what they're going to position as the savior. They'll say, wow, we've screwed up the economy. We've broken it. Here's what we're going to do. We're going to introduce the central bank digital currency, and here's why it's good. A, B, C, D. Tell you all these great things about it. It's a mistake, and it's going to be horrible for all of us. With a central bank digital currency, you're immediately vulnerable to things like instant taxation. They say you owe us $1,000 in tax. You go, okay, let me just get a few things worked out to figure out where I want the money to come from. And they'll say, oh, don't worry about it. We've already taken the money. And if they so decide, they can impose negative interest rates like that. They can impose a bail-in on you like that. They just take some of your money. They can track your purchases. They can control your purchases. They can lock out certain types of things that people buy. Maybe you're not allowed to buy cigarettes. They don't want you buying cigarettes. You can't do it. It'll be held up like it's a savior for all the problems that they've made, but really what they're doing is they're swallowing the dog to catch the cat. You'll see an expansion or a greater amount of financial insecurity. The number of people who are living paycheck to paycheck, that percentage of people will increase pretty markedly. Delinquencies, which are already on the rise, will rise more. Bankruptcies, which are already on the rise from a low base, will rise a lot more. Defaults on a corporate level, personal level, will all increase. And the unfair wealth gap, income inequality, that gap will only expand. A lot of billionaires got richer in the pandemic, where most of us are just worried about not catching this disease that's killing everybody. And inflation will soar. That's why I wanted to clarify about some of this, because I've told you guys, when everyone else said inflation was going higher, I said, no, it's not. Now that's starting to come down, and we had a little bit of a bounce, but it's still going to come down. As it comes down, that's when we approach what will be a pain point. And as we reach the pain point where everyone's feeling the real weight of the problems with the economy that have been foisted upon you, when we reach that pain point, the government will push the Federal Reserve to react with excessive, reactionary monetary creation, printing an excessive amount of new money until it leads up to a pretty significant and dramatic inflation. But there's things you can do about it that you'll get in a better place on the other end of this than you otherwise would have, for sure. Understand, nothing I say here is personalized trading advice for you. I break it down into 3 things. Here's what to do. Avoid, adjust, and acquire. Avoid certain types of stocks, adjust your lifestyle, and acquire certain types of investments. Let's get into it. You want to avoid overvalued stocks. Anything that's in a mania. Other manias, like when everyone's trying to rush to get land in the metaverse, then you don't want to be doing that. Stay away from crowds. You want to stay away from investments in companies that make luxury goods, discretionary items, really expensive restaurants, things which are highly speculative, especially a lot of these companies that aren't even making any money. And it goes without saying that you want to avoid all these zombie companies, which are companies which are only able to exist or not go out of business because they're paying the carrying costs on their debt loads. And there are several hundreds of them publicly traded right now, zombie companies. When we get into a recession, these companies are going to be in a lot of trouble. And you also want to avoid purchasing real estate right now. Don't be afraid to sell real estate, but avoid purchasing it. For the time being, there will be a time to act and take advantage. A lot of these things that are happening, stocks coming down, real estate coming down, that is just basically opportunities coming towards you. And what do I mean by adjust? The second thing I want to talk about, avoid, adjust, acquire. Adjust means adjust your learning, your understanding of the markets. You want to learn more as much as you possibly can. I always tell you that we have access to all information available right now at your fingertips on your smartphone. So take advantage of that. Give yourself half an hour a day to try to learn more. Half an hour a day, that's all I'm asking. It'll change everything for you. And focus on what you're going to do. What is your strategy? Do a personal financial audit. How much money do you make? How much do you owe? How much do you spend? Who are your dependents? And understand that your dependents will almost certainly change. You might have elderly parents that you're not taking care of right now, that you will need to be taken care of when they realize that they just got part of their pension ripped out from underneath their feet by doing nothing. All of a sudden they have way less money. You see, that's a death by 1,000 cuts. They just disperse it among everyone. They screw up the economy, and then it's like, okay, everybody, you each lose half your retirement savings. Problem solved. And most importantly, get your mindset right. I talked about this at length in the 3rd edition of Penny Stocks for Dummies. And I'm going to talk about it even more at length in my upcoming book, Stockology. That book will not be out for many, many, many years. And lastly, you want to acquire, this is the most important part, you want to acquire the right types of investments for this economic situation that you're in right now, which means real, actual, tangible things, rather than altcoin or property in the metaverse or a non-fungible token. You would own physical precious metals. You would own real estate that you buy on the cheap when it all comes down. Get into stocks that are involved with precious metals. Get into stocks that are involved with all kinds of commodities. Commodity prices will likely go higher. They will go dramatically higher when the next bout of inflation comes around, but it won't be for a while yet. You may want to look into some dividend-paying blue chip stocks or some defensive stocks. And I don't mean military defensive. I mean defensive industries like utilities, for example, that pay a dividend. They are much less volatile, and they usually hold up pretty well through a recession, as do a lot of healthcare stocks. I would say buy what you know. If you're a nurse, invest in biotech or medical stuff. If you're an oil rig worker, invest in energy companies. Always buy what you know. That's your hidden secret advantage. And I would say buy less things. Focus more. Whatever amount of money you have, you're probably mostly invested already. Try to narrow your focus. Eventually, you're going to want to buy real estate on the cheap. You'll know when it's time, and I'll tell you when it's time. That's why you subscribe to the channel. And we tell you specific stocks under $5 each generally that we think will do really well through the newsletter. However you look at it, we're in this together. We're in a really tough financial situation. Even the people who screw up everything for all of us, who have ruined us all financially, they don't even know yet that they've done it. They don't even know they've done it. So how are they going to fix the problem? They don't know the house is on fire. And eventually, we're all going to suffer because of poor decisions up until this point.